Hey investors, welcome back to the channel. I'm thrilled to be here today, diving deep into the world of YieldMax ETFs with a special focus on our newest fund, SLTY, and our standout performer, ULTY. I'm Michael Khouw, the newest YieldMax strategist and spokesperson, and I'm here to share my journey, break down these innovative funds, and give you a clear picture of what YieldMax is all about. Buckle up, because we're covering everything from SLTY's bearish tilt to ULTY's hedge fund-like flexibility, plus tips for navigating these ETFs. Let's dive in. My path to YieldMax. Let's start with how I ended up at YieldMax. I've been an options trader since the late 1990s, navigating the ups and downs of markets through bull runs, bear markets, and everything in between. Over the years, I've become a regular contributor on CNBC, where I often share my thoughts on big market themes. For the past couple of years, Bitcoin has been at the top of my list. It's a volatile, exciting asset that's captured the world's attention, and with it comes interest in companies like MicroStrategy, which has made bold moves in the crypto space. That's where YieldMax's MISTY ETF caught my eye. MISTY is YieldMax's largest fund, built around an options strategy tied to MicroStrategy. As I started getting questions about it on CNBC and in interviews, I dug deeper. The fund's approach, combining long stock positions with options premium collection, was intriguing. One day, I mentioned MISTY in a video, breaking down its strategy and why it's such a unique play in the ETF space. Turns out that video got the attention of YieldMax's leadership team. Mike Venuto, our chief investment officer, Jay Pestruccelli, our head of trading, and Scott Snyder, our lead trader. They reached out, we hit it off, and I even joined them for a NASDAQ bell-ringing ceremony in New York, a surreal moment. So, what's my role here? I'm a strategist and spokesperson focused on making YieldMax's strategies clear and accessible, especially for investors who might not be options experts. Options can seem complex. Terms like delta, theta, and implied volatility might sound like jargon. But my job is to break it down so you can understand how these funds work and how they might fit into your portfolio. I also collaborate with our investment team, contributing ideas for new products and strategies. Mike, Jay, and Scott are the engine behind YieldMax's funds, and I'm here to amplify their work by communicating directly with you, our investors. Whether you're a seasoned trader or just dipping your toes into ETFs, I want to help you navigate this exciting space. YieldMax is shaking up the ETF world with its options-based strategies. Unlike traditional ETFs that track an index or hold a basket of stocks, YieldMax funds like MISTY, ULTY, and SLTY use options to generate income while taking a directional view on the market. This approach offers something for everyone, whether you're bullish on stocks or cautious about a downturn. It's like having a toolbox where you can pick the right tool for the job, depending on your market outlook. Our funds focus on high-volatility, actively traded stocks. Think Tesla, Nvidia, MicroStrategy, or even newer names like Oklo or IonQ. These are the stocks that move markets, capture headlines, and draw trading volume. By selling options against these stocks, we collect premium, which becomes the income distributed to investors. It's a strategy rooted in options trading, which I've done for decades, and it's exciting to see it packaged in an ETF format that's accessible to retail investors. This packaging lets investors get complex strategies in a single ticker, with transparency and daily NAVs you can track. Next up, let's dive into SLTY, our newest fund, and how it complements the rest of the lineup. Let's talk about SLTY, our newest ETF, which just started trading this week. I'm pumped about this one because it's a game changer. Most YieldMax funds like ULTY or YAX have a bullish bias. They're designed to profit when their underlying stocks rise while collecting options premium to boost returns. But not every investor is always bullish. Markets go up, but they also go down, and SLTY fills a critical gap by offering a yield-focused ETF with a bearish tilt. What does that mean? SLTY aims to generate income through options premium, typically by being short stocks or synthetically short, often selling puts or call spreads. Unlike ULTY, which holds long positions in stocks like Apple or Robinhood and sells calls against them, SLTY takes a bearish stance, benefiting when its underlying stocks decline. It's not a perfect inverse of ULTY, they don't hold opposite positions, but it lets you express a cautious view while still earning income. This is rare in the ETF space where most yield-focused products lean bullish. Why did we launch SLTY? Because investors need flexibility. Markets are unpredictable, and having a fund that thrives in a downturn gives you a tactical edge. Imagine you're at a buffet. ULTY is the hearty steak for bullish times, while SLTY is the spicy dish for when you're betting on a market dip. Together, they let you tailor your portfolio to your outlook, whether you're optimistic or skeptical. SLTY's holdings include high volatility names like MongoDB, Bill.com, Dell, and even some MicroStrategy. These differ slightly from ULTY's top holdings like Oklo, IonQ, or Apple, each weighted around 5%. The funds are fully transparent, so you can check their exact holdings anytime. SLTY and ULTY both distribute income weekly, unlike MISTY, which pays every 4 weeks. This weekly cadence meets the growing demand for regular payouts, making these funds a go-to for income-focused investors. So, who should consider SLTY? It's for investors who want to hedge their portfolios or take a bearish stance while still collecting premium. Most YieldMax funds like ULTY YieldMax or single-stock ETFs have a bullish delta, meaning their value rises with their underlying stocks. Delta is just a fancy term for how sensitive a fund is to changes in its stock's prices. For example, a delta of 50 means the fund moves half as much as its underlying assets. By adding SLTY, you can reduce your portfolio's overall delta, balancing out that bullish exposure. Think of it like a seesaw. If you're heavy on bullish funds like ULTY, your portfolio tips toward market gains. Adding SLTY brings it closer to neutral, reducing your exposure to market swings while still earning income from options. Back when I worked at a hedge fund in Los Angeles, we used a long-short strategy, buying stocks we liked and shorting those we didn't, to lower our portfolio's volatility. SLTY does something similar, letting you pair it with bullish funds to mute market risk. Let's address a common concern: share price declines in funds like ULTY or MISTY. I hear this a lot. Investors see the share price drop and worry. Here's the truth: share price isn't the whole story. Take ULTY. Over the past year, its share price fell 49%, but its total return, including distributions, was 25.6%. That's because YieldMax funds pay out significant distributions, often from options premium, which reduces the share price but puts cash in your pocket. Think of it like a fruit tree. The tree, your investment, produces fruit, distributions. When you pick the fruit, the tree looks smaller, but you've got a basket full of apples. If MicroStrategy drops, MISTY's share price will reflect that because it's long the stock. Same with ULTY. If its stocks like Nvidia or Apple decline, the share price follows. But those distributions are your real return. SLTY helps in a downturn because its bearish tilt means it can gain when stocks fall, balancing your portfolio. For long-term investors, don't obsess over share price or net asset value, NAV. Total returns are what matter. Stocks generally rise over time. Think of your 401k or stock-based compensation. So hedging with SLTY is great for tactical moves, but don't eliminate all your equity exposure. You want to stay in the game for long-term growth. What can you expect from SLTY's yield? It's tricky to predict long-term because it depends on implied volatility, the market's expectation of future price swings, and the behavior of underlying stocks. In high volatility environments, like around the September FOMC meeting, SLTY can collect more premium by selling pricier options. Right now, with the VIX at 14.4, volatility is low, so premiums might be smaller. But SLTY's high volatility holdings like MongoDB or Dell should deliver strong distributions, especially if volatility spikes. For example, today's market rallied after comments from Jackson Hole suggested rate cuts are back on the table. For bullish funds like ULTY, that's great. Stocks rose and the calls they sold lost value, boosting returns. For SLTY, a rally isn't ideal, but our team can adjust, buying back short positions at lower volatility to capitalize on market moves. Why did SLTY launch at $50 per share? Some investors think that's high, but it's strategic. Starting at a higher price avoids trading at low single digits, which can seem unappealing. Reverse splits, which adjust share count, carry a negative connotation, like a warning sign for single stocks. But for ETFs like SLTY, they're just cosmetic. It's like slicing a pizza into fewer bigger pieces. Your total value doesn't change. We'd only consider a reverse split if the price drops significantly or exchanges require it, but it's not a priority. Focus on total returns, not share price. Now let's talk about ULTY, one of the most unique covered call ETFs out there. I'll be honest, it's my favorite YieldMax product. Why? It's like a hedge fund in ETF form, blending diversification, flexibility, and high returns. ULTY holds a basket of high volatility stocks. think Oklo, IonQ, Robinhood, Apple, and uses option strategies to generate income. Last year, it delivered a 25.6% total return, beating the S&P 500's 17.44%, even through brutal market swings like the April sell-off and V-shaped recovery. What makes ULTY special is its flexibility. Unlike a static strategy, say buying one stock and selling weekly calls, ULTY adapts to market conditions. Our team, led by Jay, Mike, and Scott, uses tools like protective puts to limit downside risk, especially around events like earnings when volatility spikes. For example, buying puts when options are cheap can cushion losses if stocks drop. They also use call spreads, selling an at-the-money call and buying a higher strike call, to improve liquidity and reduce volatility. This dynamic approach delivers better risk-adjusted returns, meaning you get strong gains with less wild swings. You've probably heard terms like NAV decay or NAV erosion tossed around, especially in the covered call ETF space. Let's clear this up. In options trading, decay, or theta, is the loss of an option's value as time passes. Since YieldMax funds sell options, decay is a tailwind. We collect premium as options lose value. This is different from futures-based ETFs, where rolling contracts in contango can cause decay. YieldMax funds benefit from selling options, not buying them. NAV erosion, on the other hand, happens when underlying stocks decline or distributions are paid. Picture this. You invest $100 in ULTY, get a $7 distribution, and the NAV drops to $98. You're still up 5%. That's a 60% annualized return. Investors sometimes fixate on NAV, but total returns are what count. What happens to YieldMax ETFs in a market crash or recession? Most of our funds, like ULTY, YieldMax, or MISTY, are bullish. They hold long stock positions and sell calls against them. If their stocks drop, their share prices will too. For example, if Nvidia or MicroStrategy falls, ULTY or MISTY reflects that. SLTY, with its bearish tilt, is designed to perform better in a downturn, helping balance your portfolio. Unlike some competitors using 150 to 200% leverage, YieldMax ETFs avoid leverage, which reduces risk but doesn't eliminate it. In a pullback, SLTY can offset losses from bullish funds, but it's not a cure-all for idiosyncratic stock drops. Will YieldMax ETFs be around in 5-10 years? Absolutely, and I'm bullish on their future. Options-based ETFs are a small slice, maybe 1% of the $15 trillion ETF market, but they're growing fast. Options trading volume has outpaced equities for years, driven by demand for non-linear, less correlated returns. Investors want alternatives to just owning the S&P 500, and YieldMax is leading the charge with funds like SLTY and ULTY. If you're considering YieldMax ETFs, here are some tips, not financial advice but practical guidance. First, align your choice with your market view. If you're bullish on Bitcoin, MISTY is a great fit, but if you already own crypto, avoid overexposure and consider a diversified fund like ULTY. Second, think about rebalancing. If you allocate 5% of your portfolio to ULTY and get a distribution, reinvest it to maintain that allocation like a drip strategy. Third, use SLTY tactically to hedge bullish positions, especially if you're worried about a downturn. It's like buying insurance. You hope you don't need it, but it's there if you do. Finally, focus on total returns, not share price or NAV. Reinvesting distributions can keep your exposure steady, and our weekly payouts give you flexibility to adapt. My mission at YieldMax is to boost transparency and communication, helping you understand these funds, while our team focuses on managing and innovating. With inflows soaring and funds like ULTY, SLTY, and MISTY gaining traction, YieldMax is on an exciting path. Whether you're a current investor or exploring our ETFs, keep your eyes on total returns and portfolio goals. The future is bright, and I'm thrilled to be here guiding you through it.